This is On the Market, a Bigger Pockets podcast presented by Fundrise. Hey everyone, welcome to On the Market. My name is Dave Meyer. I'll be your host today, joined today by Kathy Fettke, James Dainard, and Jamil Damji. How are all of you?
We are all sick. Woohoo! It was a great party.
Every single one of us is sick. I think we're going to have like a lot of muting of microphones.
I might have to take responsibility for it.
It was Jamil's fault, apparently. But I wasn't even at the party, and I'm sick too, so I don't know.
Well, that's because we mailed it to you.
Oh, yeah.
Well, thank you. I appreciate that. I really appreciate you including me. It's very thoughtful. Well, I actually wasn't at the party, but I did get to do something very fun, which was I was in Madrid, Spain, and I got to meet in person the entire team that edits this podcast. They all live in Madrid. I don't even know if you guys know that. But I went to go hang out with them, and they're extremely cool, fun people. They took me on a 10-hour tour of the inside of many bars in Madrid. And I just wanted to give a shout out to Joel, Eliezer, Alexander, and Anna, who are an incredibly talented team. It was a pleasure to meet them, and I had a lot of fun with them. Very talented, passionate people who make this show possible. So that was really cool for me, and I just wanted to tell you guys about it.
Amazing. I had no idea that they were in Spain, but now we have to make a trip out there and go hang out.
Sounds like we have to.
Are they sick of our voices yet?
No, they were making fun of me the whole time. They were like, I feel like I have to like put a frame around your face. Like that's what I'm used to seeing you like. Like it's weird seeing you. No, they would love that. We should do that next time. Kathy, next time you're in Portugal, just pop over to Madrid. It's not far.
April.
All right.
Did anyone say to you that you're taller than they expected?
No, probably said shorter, knowing me.
I always get, oh, you're thinner than I expected you to be, and I don't know how to take that. I'm like,
Well, they were probably already thinking you're very thin and muscular, so even thinner.
I get you're thinner than I thought, and your beard doesn't look as terrible in person as it does on video.
What?
Nobody says that to you.
Who thinks your beard looks terrible?
I have no idea, man. The internet's fun.
Well, I can't even grow a beard, so.
That's what happens when you're one of the America's best investors and you're only 12, James.
That's like one of the Bigger Pockets podcast headlines, like 150,000 units by 12 years old, featuring James Dainard.
Profit in puberty.
Wow.
That could be your BP book pitch, James.
I think I'm going to write that down.
All right, well, let's get to today's episode. As we wind down the year, we wanted to recap and sort of go back to actually one of the first shows we did, which we were picking best markets, worst markets. And so today we're going to talk about our predictions for the best and worst markets for 2023. But before we do, Rocket Mortgage, one of the biggest mortgage companies in the country, just came out with their rankings of the top 5 markets for 2022. So I want to throw these out there and see what you guys think about these before we get into our predictions for next year. So they say the number 5 was Charlotte, North Carolina. Did any of you pick them last year? I feel like someone might have.
I did.
Oh, you did?
Didn't I?
Why do I feel like...
No, Jamil, you had Austin and Denver. I remember that specifically.
Austin and Denver, that's right.
Because the final was just you against yourself.
Yeah. Yeah. Charlotte.
So is Charlotte, do you invest there, Kathy?
Yeah.
And how did it do this year?
It got very expensive this year, so it became difficult to buy this year. But if you bought before this year, you did great.
Nice. Then number 4, we have Nashville, which is sort of, I feel like, perennially on everyone's list of top markets. Then we had Raleigh, number 3. Tampa, which I said, but got voted out early, for number 2. And Austin for number 1, which I was kind of confused by. I think that's actually what won in our competition next year. But would you guys think Austin was the best performing market this year?
I mean, if you look at those first 2 quarters in all those tech markets, they jumped so high. It's like they had room to pull back and it was still going to be good. It's, Scottsdale was kind of like that too. Like it was like Scottsdale, Austin, Seattle, LA, San Fran. I mean, they just shot up. So
Well, that's a good question, James. So you've been pretty honest about pullbacks in Seattle in your market. Are they still up considerably over pre-pandemic levels, prices in Seattle?
Oh yeah, we're substantially up from. I mean, we're still 5% up on this year in Seattle, but we were up 25% to 30% in those first 2 quarters. I know. There was 1 month alone. I was seeing some cities appreciate at 25% in 1 month.
Wow.
It was crazy.
Unbelievable.
I had to triple check the data. I was like, wait, what happened? The median home price jumped 25% in one, and like
That's like a crypto coin.
yeah, I mean, we're still at least 30% up from 2020.
Yeah.
So, or 25 to 30 in certain neighborhoods for sure. And so there's still rapid growth. It's just sliding back with the affordability right now.
Yeah, I mean, that was kind of my comment last year, is that this is a leveling out of a crazy manic pandemic induced buying spree of last year. And so with so many things, when we see layoffs, when we see home prices coming down, it's really just comparing to an abnormal year. And so if you could keep that in mind and maybe just compare numbers to 2019, people who bought in markets that really went up and are now coming back down to earth, if they bought this year, they might be feeling a little pain. But if you bought before that, you're fine. And if you hold it, you're fine. It's just anytime you have to sell, if you're forced to sell when it's not good timing to sell, then that can be painful. But if you can hold, usually those hot markets come back and they become hot again.
I feel like if you bought a house in like the peak time of 2022, it's kind of like one of those nights you got really drunk at a party and things didn't, turn out the way that they should have, and you want to forget it, and so that's basically what happened. So.
Is this what happened at your party last weekend, Jamil?
Maybe.
I left in time.
We listen. We all have the same. We all have the same sickness, and how that happened.
I don't know how to follow that up.
I put on a good party though, guys.
That was a good party.
Let's be real.
And you know what? Everyone should go to Jamil's meetups and parties. They're the most fun things for real estate I've been to. It's like, it is a vibe that is like nothing I've seen at a real estate conference before or meetup.
I'm signing up.
All right. Well, definitely check those out. Okay. Well, let's take a break now because Jamil, you threw me off. So let's take a quick break and then we'll come back and talk about our predictions for 2023. All right, let's jump into our predictions. But before I ask you which markets you actually picked, can we talk quickly about what criteria you all used? We're going to do our worst markets first. And when Kaylin and I assigned you these, we didn't really give like definition what worst means. So I'm curious, Kathy, what did you interpret that as? What did you think? How did you choose the market you chose?
I had to really give it some thought because with real estate, you can get super confused. There's so much data coming from so many different angles and everybody's got an opinion, and that's 100x'd every year as more and more people get into the industry. So it can be very confusing. So I just had to stop and say, for what? What the worst market for what? And for me, my buying box, basically what I have always looked for are areas that cash flow with the hope of appreciation because there's something going on in that area. There's growth. And so I don't need it to go up in price dramatically right away. I just want it to over time so that I know that I'm getting cash flow and appreciation, because the double whammy is what can really make you wealthy. So for me, the worst market I chose was Detroit. Now, Detroit came up on some lists as a great market for 2023. So again, it just depends on your buy box. And I'm sure there's Detroit investors listening who are like, if you invest the way I invest, you'll do great in Detroit, because there is a lot going on. It apparently has had some of the highest millennial growth there. There's a lot of revitalization happening downtown. So some of the things I look for are there. The reason I choose it as the worst for me is that they've had a population decline over decades. It's
Long time.
Yeah, decades. Yeah, Detroit has seen a 61% decrease in its population since the 50s. So it used to be really quite like a New York kind of city, very popular city. But people are leaving and they're going to where my favorite market, one of my best markets is, warmer climates, the Florida area. I didn't tell you where in Florida, but warm climates with landlord-friendly laws. This fits the buy box for me. So if I'm looking for buy and hold, cash flow, appreciation, and growth, I want to be in an area where there's job growth, population growth, infrastructure growth, rent growth, all those things. And we're not seeing it. But the biggest reason that I wouldn't invest in Detroit is that they have this law. And it is a tough law, and I know it well. So in May of 2017, the city of Detroit announced its intention to implement a citywide effort to enforce tougher rental ordinance rules on landlords. So landlord rules really matter. Basically, you can get massively fined. Depending on which way you look at it, for renters, this is great. It means that landlords have to take care of their properties and fix things. But if you are, if you're not aware of that, you can get really stuck. We're trying to sell 3 Detroit properties in our former fund, my last single-family rental fund. We're down to 3 Detroit properties that we're having a really tough time selling. We can't get the tenants out because landlord laws are really not in our favor there. And the city comes in and inspects and tells us all these things we have to fix. And those fixes are costing a lot, $40,000 to $50,000. And these are properties we only owned 5 years, and we fixed them 5 years ago. So they're older. They tend, if you're buying an older property in Detroit, you just have to know that the city inspectors may charge you. So for me, this is not a best market for me. It's a worst market for me. I do think if you go in and you can get a great deal and you completely renovate it and you've got the budget for it and the reserves, you could get great cash flow. I just don't think that you're ever really going to see that market appreciate the way I like it to do in other markets.
All right. Detroit is our first worst city. I know the former CEO and founder of biggerpockets, Josh Dorkin, would definitely agree with you. He made a reputation of hating on Detroit for many generations.
I used to love it. I used to invest there. And our fund bought a bunch of properties there, and they cash flowed the whole time during the fund. They were wonderful for cash flow. It's just when you're trying to get out, or if the city comes in and tells you to do a bunch of work you weren't expecting to do. So you just have to have lots and lots and lots and lots of reserves for older properties.
Kathy, it's a great point. 2 or 3 years ago, I did this data analysis to look at appreciation versus cash flow for markets, and I plotted them out. And basically what we saw was that before the pandemic, most markets were either really good appreciation or really good cash flow. And there were a few that were both, but they were modest for both. The outliers for good cash flow, like Detroit, were also outliers for bad appreciation, right? Mm-hmm. And so you saw the other thing too, like an outlier for appreciation, like Seattle, was also an outlier for bad cash flow a lot of the time, just on average. And since the pandemic started, all that got thrown out the window and everyone has just, seen both. But I do think as we go into 2023, we're going to start going back to that normal sort of bifurcation in the market where some markets are really good for cash flow, but don't appreciate really, and vice versa. Some will continue to appreciate, but aren't going to be, places where you can easily find rental properties that meet the 1% rule, for example. And so it sounds like you agree. Detroit might be good for cash flow, but appreciation probably not going anywhere.
Yeah, and I think it's really important to look at how performance was before 2020. And, I know a lot of these cities have really redefined themselves in the last decade. But if you take, say, 2015 to 2019 and really look at the cap rates and what was happening in those markets, appreciation-wise, those were good, solid years for real estate. So that will be a better metric for where we're headed in 2023, I think.
All right. Well, there we got one. James, how did you approach this, and what city did you pick?
So I picked kind of a different city. I wasn't, I spent a lot of time researching all these markets, and I'm like, you know what? I'm going back to the market that I had the biggest regret of not buying in 2009. And so I picked San Diego, California. And The reason I picked San Diego is and this has nothing to do with what we're going through now because it's a different thing. But I remember in 2009, the skyrise condos went down to like under 400 grand. These things were like, you'd be up, killer views, brand new, and you could buy them for under $500,000, and they were trading for over $1 million before the mortgage industry exploded. But the reason I picked San Diego is I do think, I think San Diego is the best city on the West Coast. Like, it is where you want to live for sure. But the problem is the income is just not there and what people can afford in the job market. And it's a really good place to move to if you have money. But if not, you're going to struggle with a lot of the pricing around there. And so what we've seen with the interest rates rising is the rates. We've already seen it go from a medium home price down over 10%, right? There's been a drop from about 950 down to 850, and we've seen something very interesting to watch for. And these are the markets I'm most cautious in right now, are the ones that hockey stick up in that first 2 quarters at a crazy rate. And San Diego definitely hits that. In March, they were up 30%, and they were one of the top 3 appreciating markets for that month. And it has retracted back 20% from March, and it's continuing to slide right now. And I think a lot of the reason that they have retracted back is the math just doesn't quite make sense. Like, also rents have dropped 5% since March as well. And I do think the rents are falling because more the remote work. Like, why wouldn't you want to remote work in San Diego if you could? Like, that's where I would want to remote work. And so, like, as the workforce is going back to where they're supposed to be working, all these things are starting to kind of bring it back. During the pandemic, living in a quality place was a big concern for most people, and San Diego is one of the best you can be in. And so I think people are just starting to leave a little bit, and it's starting to delay things down. But to put it in perspective, you have to save in San Diego, the average home buyer needs to save up $160,000 to buy a house.
Wow.
With the income that they're making, they need to save a minimum of $13,000 per year. It's going to take them almost 8 to 12 years to save up for that 20% deposit. And that doesn't even keep track with the pricing going up during that time. And, with a median home price of $905,000, the household income should be $166,000 to afford that comfortably. The problem is the median household income there is $70,000. And a lot of the actual jobs that are in San Diego are big. There's not as much, and I picked San Diego because there's not as much big business as there is in like Austin, Seattle, San Francisco, where there's these big anchor tech companies that, yes, they might be going through a downturn right now and laying off some people, but they're going to come back. And these are companies that are not going away. Whereas, they have a much more limited pool. Military is a big deal. Now, I do think if we are going into more conflict, that the military could grow and that there is going to be, that could expand in San Diego because it's the biggest military base there is. But it still doesn't get you to the income for affordability. And with rates being as high as they are, it's just going to pull everything back because just people are not making enough money to buy. And we're seeing that right now. And if the rates continue to go up, which I do believe they will, for at least the first 2 quarters, you're going to see homes dropping price. 43% of all homes in San Diego have cut their price this year. That is a substantial amount. That means people are either overpricing, or even if they are pricing right, they're just not selling for, people can't afford them. And the major pool of that, they can't afford that. Those big companies are slowing down. Like Qualcomm is a huge business there. That is one of their anchor employers. Qualcomm has froze their hiring right now. They have not announced layoffs yet, as far as I could tell, but that's usually the first step. You freeze your hiring, and then there's layoffs coming. They have not predicted the layoffs, but they are expecting, the company internally is expecting that their shipments are going to decline in the double-digit percentage for next year. So they're predicting that they are going to do less business as a company, which is going to start laying off the people that are going to absorb a lot of these more expensive properties. And so all those things that when you get in a mix, I just see this stuff coming down. It's way too expensive. We're missing like $70,000 on the median home price to get people to really be able to afford. And then there's other things that are just indicating that it's way better to rent versus to buy. Like the cost to rent ratio is 30.38. In a healthy market, you want to be below 21. So it is so far out of whack right now that I think that San Diego could fall like an additional 10% from where it's at right now. And, you know, that doesn't mean that I wouldn't buy in San Diego. It's actually on my cities to slate to buy in. I just think that there's going to be more opportunities. I don't want to have the same regret I had in 2009 because I do think quality of living and people want to live there in general, and that's always going to drive growth. They're also on a long-term basis predicting that San Diego's economy is going to grow. I think they said 31% in the next 10 years or 20 years. And so they're predicting growth, but in the short term for 2023, I think it's going to retract back. And I think all these expensive West Coast markets are going to continue to retract back. And the thing you have to be careful about with the investors is when you're playing in expensive markets, the retraction can really hurt. And so that's why I put this as the worst market that I would invest in.
Everyone loves leverage when you're going up, and then when it goes down, it hurts a lot.
Oh, it definitely hurts. Like what we were talking about before I got on the show, I finally sold a house that it took 150 days to sell, and luckily I'm breaking even. I don't even know how I'm breaking even, but we just sold that house for $450,000 less than a house that we sold right around the corner when we bought that deal in the beginning of the year. And so you have to watch out for these slides. And the slides are okay. You just have to prepare for them correctly. But I do think San Diego is going to have some issues. It's just too expensive for what people make there. And, and I do think people are always going to want to live there. Well, in addition to, besides that expense, you have that California expense, right? The extra 13% income tax. There's too many expenses going on that are eating up liquidity. And that's why I do think that it's prone for a pretty big drop from here. I think another 10% is coming back.
So San Diego might be on your best markets for 2024 list.
Yes. Yeah. I actually think all those markets, like Seattle, right? Like it's a very similar. I like Seattle better than San Diego because there's more jobs there. I like Austin better than San Diego because there's more jobs and infrastructure there. But I do think all these cities that are having these massive retractions are great buying opportunities, especially after this second quarter. But you have to buy carefully. You can't buy traditionally. If you're buying traditionally, you're going to I think you're going to get burnt. But if as the markets keep free fall, those are the markets that are going to have the most opportunity. The ones that are falling backwards are the ones that everyone just jumps out of, and that's where I really want to jump in. I probably will buy something in San Diego. I want to buy like some short-term rental stuff right down by the beach in PB. There's I know the condo market gets hammered, and those are things that I'm looking for is like if I can buy it substantially below what it was worth. If I'm buying them 30-40% below that previous median home price, there's runway for growth and equity gains in over a 5-year period. But like what Kathy said, it comes down to what is your strategy. My strategy isn't high cash flow. I don't like dealing with these small houses that can get you 10 to 15% returns because I don't like those maintenance expenses that can jeopardize my cash flow position. I like high growth markets because that's where you make those big equity gains. And those equity gains have completely changed me as an investor and how I've been able to passively invest just based on those gains.
All right. Well said. Yeah. I actually, when I was trying to think through this for best markets, I was thinking of doing a contrarian opinion and saying something like Austin, because I think it is going to go down 20 or 30%, but it has one of the best long-term growth potentials of any city in the country. And so maybe it is a great time to buy in Austin if, to your point, James, you're buying under market value and finding good value. All right, Jamil, what about you? How do you approach this?
Well, I loved everything that James and Kathy said. I agree that you have to look at it from the perspective of your investment strategy. And we all know that I am a trader. I look at the real estate market in terms of how can I benefit? How can I get involved? And where are my buyers? Where are my clients? Where are they looking to invest? Where are they running away from? And so for the worst market of 2023, I've chosen Ventura County. And Realtor.com predicts that it will drop in sales price by about 30%, 29.1 specifically is what their prediction is. And that's a significant amount of money, right? And there's not, when you look at fix and flip, when you look at wholesale, when you look at opportunities for us to trade in property, if you've got a declining market to that degree, with all of the things that James was talking about, you've got the regular Southern California issues like the state tax, the migration in Ventura County it's flat if anything. And so how I look at a market like that is I say, are my clients or are my buyers for fix and flip or are my wholesale buyers looking for opportunities in Ventura County right now? And they're not. And so for me, where we are not going to be investing marketing, where we're not going to be investing resources for boots on the ground to try to find some opportunities or to pick up opportunities for trade, will be some of these higher value markets in Southern California. But I do also agree that looking forward to 2024, as you had mentioned and as James had mentioned, there's going to be a tremendous value, but you have to wait. So it's a bad market for 2023, but coming off the tail end of that, if you can start buying in Q4 of 2023 and get them significantly below market, because at that point there's going to be desperation, exhaustion. Sellers are going to be they'll have had it. And I feel if you can time your purchases right, you can make the worst market of 2023 your best market of 2024. And so I'll be re-entering Ventura and some of those markets in Southern California towards the tail end of 23. But for now, the worst market, Ventura County.
Okay, it makes sense. Kathy, what's your read on this California hate over here? We're getting James and Jamil. But really, like, we're seeing, a lot of population leaving California, and it's very expensive. I feel like people have been saying California is going to nosedive for decades, and it never happens. So, what do you, as a resident and a native, what do you think the future holds for California in the next few years?
I am a native of many generations. My grandmother was one of the first people to swim. She would swim across the Golden Gate Bridge. She was an Olympic athlete and would swim around Alcatraz. So I really have my roots in California. And this is a conversation that has been had probably for a century, and it's just always the case when you have highly desirable world-class areas. It will never be cheap, and there will never be a lack of people who can afford it. It's just that they're volatile. These are volatile markets, but San Diego, it truly is one of the best places in the world to live or to have a second home. And there are more people that would buy there or own there than work there. So obviously, if you're trying to buy, trying to do a buy and hold, again, it just depends on strategy. But it's almost like if you can do a long-term flip, meaning like maybe you buy something, you rent it out for a year or two, where it's kind of covering its cost. It probably won't. It'll probably still be negative. But then do the flip later, so you kind of got in low.
If you can never get the tenant out.
Yeah, right? There is that.
Valid point.
But, it always has bounced back. And you will make a lot of money if you hold. That's why so many Californians are loaded and are bringing their money to other places, because they made their money in housing in many cases. So if you live in California, so what I think of California, I would love to leave California, but I love the weather. I love everything about it except the politics and the prices, but it would be hard for me to go anywhere else. And I think a lot of people feel that way who live there.
All right. Well, yeah, I wouldn't bet against the California market long term. It always bounces back. Oh, and one thing I did want to say when you were talking about that could be a very good opportunity for like a live-in flip for people who want to do that. You get to live in California and then flip it down the road. And if you live in it for 2 out of 5 years, you pay no tax. So
absolutely.
Good opportunity.
Yes.
For mine, I wanted to pick a city that we don't talk about a lot, also on the West Coast, but was one of the hottest markets over the last couple of years. And I picked Reno, Nevada. Do you guys know anything about Reno?
Just sold off our 2 subdivisions there just in time. So yes.
Oh, good.
Yes.
Well, it went crazy over the last couple of years. So hopefully you did well there. But
sold right before rates went up. So that was good.
Nice.
Congrats.
Thank you.
Because to me, Reno is like one of these cities that just popped due to remote work. Like, it's a beautiful place. There's no income tax. It's right near Lake Tahoe. It's really nice. But when you look at the economic fundamentals, it doesn't really support all the growth that we've seen. Similar to what James was saying about San Diego, you just see a really not a high enough income level to support the prices. You don't really see, unlike Seattle or Austin, that has like exceptional job growth and tech companies moving there. Don't see that to the same degree in Reno. And so this is, to me, going to be an interesting experiment, because I think it grew a lot, similar to Boise. I think it's sort of a similar thing where people who wanted to live somewhere with a great quality of life decided to move there. But we'll have to see if the economy can support it once people are either called back to the office, or salaries don't rise at the same rates that they have been, or there's layoffs like we're starting to see. So unfortunately for Reno, I don't think it's going to be doing pretty well over the next couple of years. It's already seen the days on market go up by about 250% over the course of this year. We're at days on market over 60, which is in any market pretty high. And price drops are over 45%. So that's my pick.
Well, I could tell you why we invested there, why we bought land there. And,
why?
And built a lot of houses there. Because Tesla moved its battery factory there, and there was just Google was moving up there because it's only about 4 hours from San Francisco, but it's in Nevada, no state income tax. So it just seemed like this is going to keep growing. But like San Diego, it just lags. And it's so strange why you would think for those reasons companies would move to Nevada just to avoid taxes, but it's still a 4-hour drive. If there was a speed bullet train or something, maybe it would be a different story. I don't know, but it's always lagging. Yeah,
the income just hasn't grown there in the way that it would need to support some of these prices.
Don't they run out of water? Like, isn't there a huge water issue in Reno too? Like, it's dry almost. Like, I just remember when I went to Lake Tahoe, they were talking about it. Like, the water's low, and they're trying to figure out how to get more water in. And
I think in general, that was California.
Yeah, and Nevada.
It's also crazy too. Like, when you go to Lake Tahoe, that property values, because part of it is in Nevada, and they call that Millionaire's Row on that side, because that's where all the mega mansions go. So I get what Kathy was doing. Like, they want to get out of that income tax, and it's like, so you have properties that are worth millions and millions of dollars on one side, and then just kitty corner, they're worth 45% less because there's no income tax.
No, that's interesting. All right. Well, we've talked about the downside, and again, I think some of these markets could be great in the future. We're just talking about 2023, not forever. So let's move on to markets that we do think are going to outperform or do well in the next year. So, Kathy, on the other side, you didn't like Detroit. What do you like for next year?
Well, as you know, like I said, we always look at job growth, population growth, and infrastructure growth combined with affordability. So that I want to be in markets that cash flow today, and so you can hold these properties. They don't have to cash flow a lot. This is a long-term play, but cover their costs so that you're really able to hold these as they appreciate. And Tampa really fits that for me. Tampa has completely redefined itself in the last decade. In fact, just in 2021, there were 9 companies that relocated their headquarters. There's an article that says tech company relocations to Tampa Bay soar in 2021. 94 new companies were added to St. Pete's pipeline. So lots of job growth, and that's really important to us. Now, with that comes population growth. In Tampa, it was 1.3% up last year. And this is the important thing. Looking forward, it's projected to grow 3.3% annually. So The growth has just started. More than 128,000 new residents are forecast to move to the metro area. How on earth, by next year, by 2024, there's not enough housing for all those people. So, and we're still buying houses in the $150,000, $200,000 range, just about 45 minutes outside of Tampa. I don't like to be too far away from a major metro, but if it's still driving distance and there's still offices and jobs nearby. So just on the outskirts and out of flood zones and out of the hurricane zones, kind of more inland of Tampa, we are really finding amazing deals. So I think if you can still get a house for $200,000, $300,000 in an area that's growing like that, to me, that's a steal. Median rent is $2,300 per month for a 3-bedroom home. So there's a lot of markets where it might be a 2-bedroom apartment or something, but according to Zumper, $2,300 for a 3-bedroom home, that's pretty good. Rents have increased by 16% last year, and 48% of households in Tampa rent rather than own. And I think we can all agree that Florida in general is business friendly and landlord friendly. So it meets all the things that I want. I'm not worried at all about buying in Tampa today or the, oh my gosh, for the properties that I own in the Tampa area, I get calls and texts probably every other day of people trying to buy those homes. So there's still a lot of activity.
That's my fault.
It's Jamil. He's calling you.
I know. I keep offering like twice what it's worth and no one's taking it.
All right. Well, I love Tampa too. That's a very good pick. I mean, I think there's a lot of Florida. It just seems to be this like split state. Like some markets seem to be overheated right now, but markets like Tampa just seem to still have really strong fundamentals. So we'll have to keep an eye on that one.
And I'll just say one more thing and then add to it that the iBuyers are kind of backing off. So you have a little bit more opportunity to get in today. And we're finally starting to see the foreclosure sales kind of hit. So there's more opportunity there than there was, but all the same dynamics of growth that we like.
Nice. All right, James, what about you? What do you like for next year?
What I like for next year is, it's funny when I was researching all this, there were a lot of like the predicted markets that are going to perform really well in 2023. It's all based off math equations. Like when I was looking at all these lists, I'm like, okay, I get it. It's a very low price point. The median income's up. There's low inventory, so they're predicting growth. That totally makes sense. But for me as an investor, I also like to buy stuff where people want to live. And so I picked Raleigh, North Carolina, which I know did really good this last year. And the reason being is it is ranked on numerous lists as the best places to live in the United States. Number 6 was ranked number 6 recently. And it has a ton of growth behind it. It had a 3.4% GDP growth in 2022. And the economics behind it's Raleigh and Durham County, but there's growth going on there. The population is increasing because people want to live in quality places, but still keep their capital, right? Like a lot of our friends, like I know a substantial amount of people in the last 12 months that make good money, they have good careers, and they reload out of California. The reason they did is because they were sick of giving away that 13%. They were sick of paying too much money for housing. And they're going to areas like this. And if you look at how affordable this is for the quality of living, right? So this is the 6th ranked city of places to live that you can have a great life to live in. And the median home price is $410,000, which did grow by 16% last year. And that is my concern. It did have a lot of rapid growth. But the household income is $98,000. So people can afford to live, they can move there, have a great life, and still live comfortably. And everybody that I've known, and I also go off of what are people saying. People have been reloading to Raleigh, North Carolina, Charlotte, and they love it. They love everything about it. And that is a buzz. And as we go into a recession and things are costing more, people are going to look for areas. They just want to enjoy life and live somewhere that they can raise their kids. And this is one of those hot places. The other thing I liked is there is going to be an inventory problem. I believe that since 2010 till now, they built 50% less houses than they did from 2000 to 2010. If you have growth going on there, because the population is growing, just like Kathy said, like it's growing at a rapid rate. It is historically grown around 1.5%. It's been growing near 3% the last 3 years. And so it has the buzz, but this is where people are moving. There's a lack of inventory, and people can afford things. Another interesting stat I saw, and I was like, wow, this is pretty, it kind of blew my mind. 23% of people don't have mortgages there. That's how affordable it is.
Wow.
Wow.
That totally caught me off guard. And so when you're looking at a quality place to live, they have good income, the median home price is still very, very affordable, the schools are great, Charlotte, the big city next to it, is growing rapidly. Those are all good things for long-term gains on a property. In addition to, people want to live there. The only thing that I did see that is a little concerning is the cost to rent. And that's something that I'm really looking at now in all my metrics when I'm looking at things. Like, is it way cheaper to live in a rental? It has gone. It went from being around 16 to 17% to 19.65. So it is the gap is getting closed on whether you can rent or buy, but that's still below that 21 point threshold that they talk about. So there's still a little bit more room. It still makes more sense to own than it does to rent. And so those are things that I think are really healthy for growth for 2023. People want to live there, they can afford it, and it's still cheaper or a better situation to buy. So I think that it has a lot of room to grow. And another thing I saw, actually, that I thought, the markets I've been watching are these hockey stick markets, right? And Raleigh has jumped dramatically, but it's only came down 5%. Instead of that 10 to 20% that we've seen in some of these tech markets. So it didn't quite grow at the same rate as San Diego, Seattle, Austin. It grew about half the rate. And so it's kind of a more leveled out market. So there's less of a hockey stick going on there. But I'm going to really dig into this market. I liked all the stuff I read on it. I know I like everything I hear about people. And I really do love markets where people want to live. And Raleigh is one of them.
Awesome. Yeah. I mean, it's anchored by very, very strong economy. Three of the largest research universities in the country, Duke, UNC, NC State, are all in that area. When you have that kind of education level, you see a lot of companies moving there to take advantage of that workforce. So very, very strong economy there. North Carolina has some weird rules about buying houses, though, where you have to, like, what is it called? You have to, like, pay some fee to take the price off the house off the market. It's like putting earnest money down, but it goes hard like immediately. Have you ever heard of this?
Option fee?
Yeah, it's like an option fee. Yeah. Last year they were like 20 grand before you even have an inspection. It's crazy.
Yeah, I was just talking to someone about that, and they said, yeah, it's like two earnest. There's an earnest money, and then there's like a due diligence fee.
Yeah, it's the curb wholesaling.
Yeah.
Yeah. It's crazy, though, because like in a normal year, I talked to an agent down there because I was interested in buying in Durham, and they were saying like in a normal year, it's like $500. So it's like, all right. But last year, with how competitive it got, it was like 20 or 25 grand. Mm-hmm. That was before you even got an inspector in there. That's before you even necessarily walked the property. So people were, I mean, that's crazy. That's why I just didn't do it. But hopefully in this next year, it won't be as competitive and you can do something like that.
The buying conditions were so weird, though. Like, we used to write offers on homes. We write a 5-day close. It'd be listed for 400 grand. We would write it up for, let's say, 450,000, and we would write earnest money at 448,000 and release it to seller day after mutual. And we would write the weirdest terms we could do just to try to get that deal. Like, they're like, wait, what do you mean? We're like, no, we're going to give you all the money until we close. It's for $2,000. And like, we were trying everything just to lock a deal down, right? And so it was like, but you know, I think that will go away. From what I hear from people that are buying there, it's kind of it's back down to $500. Like, people aren't throwing crazy numbers at it anymore.
Yeah, for sure. It's wild, but agree that it's a very strong market. All right, Jamil, what do you got? What's your favorite market for next year?
Well, again, looking at this from the perspective of a trader, so I'm looking for opportunities that are quick, where my buyers can get in and do projects where they won't get slammed and have a house sitting on the market for months and months and months, where mortgage rates aren't going to be a considerable situation. Now, looking at what we've seen, we're seeing across the United States in almost every market that prices are declining. However, there is a unicorn market right now that a lot of folks aren't talking about, where that's not happening, and it is Hartford, Connecticut. Hartford, Connecticut. Interesting. Realtor.com is predicting that they will have a price appreciation in 2023 of 8.5%. buyer demand is so strong there right now that they are still in multiple offer situations on properties, and houses are selling 20% above list right now with mortgage rates where they are right now. That's how strong the demand is. It's crazy. It's like everything that we were seeing leading up to this whole market shift, all the craziness in most of the markets across the United States, we're seeing these multiple offer situations. It's still happening in Hartford, Connecticut, which is crazy to me. Beyond that, the median price over there is very low at $372. So it's still relatively affordable. And you've got strong migration. You've got New Yorkers moving there. You got people from Florida moving there. You got people from New England moving there. It's got a lot of demand. And so people are moving there. There's strong buyer demand. The mortgage rates didn't affect it because we still have multiple offer situations. So fix and flip is going to be very strong over there. Wholesaling will be very strong over there. So we're going to be doubling down our efforts as well as trying to establish more franchises in the area, because I see heavy opportunity for wholesaling and fixing and flipping in this little unicorn submarket.
This has to be the first time in BiggerPockets history anyone's ever mentioned anywhere in Connecticut as a place to. I grew up not so far from here and just never even talk about Connecticut. But Hartford has been it's a low price market, and like just anecdotally, almost most of my friends who grew up in New York with me now moved to Connecticut, mostly to Stamford, Bridgeport, like places close to the city, but. It's a real thing, and Hartford is kind of like perfectly situated between Boston and New York, and so maybe you're getting people from both of those higher price markets who just want somewhere in the Northeast that's a little bit less expensive.
They are, and there's jobs and industry there too, because it's the insurance capital of I believe the world, the insurance capital of the world. Aetna's got their headquarters there, Cigna's got their headquarters there, so we know that. There's strong opportunity in healthcare. There always will be. That's one of the industries that we understand will always have a lot of demand and a lot of opportunity. And so I think it's one of these markets that we will look at in 5 years and say, who knew? Jamil did.
Yeah. Connecticut has underrated pizza. I don't know if anyone knows that, but has better pizza than people give it credit for. It's very important.
It's where my husband was born.
Wow.
Yeah.
Where, in Hartford? Mm-hmm. Wow. All right. Maybe Jamil and Rich will have to go on a tour. All right. Well, for mine, I wanted to do something similar to Jamil, a little contrarian, some places that people haven't heard of or aren't talking about so much. And I, for some reason, maybe not in 2023, but I'm long on the Midwest. I think similar to how the Southeast over the last couple of years has seen this big pop, a lot, the weather is great, but also it's just more affordable than the West Coast and the Northeast. And I think the Midwest also has that going for it. Doesn't have the weather, I'll give you that. But the Midwest is by far the most affordable part of the country now, because the Southeast has gotten so much more expensive. And the city that I like in the Midwest the most is Madison, Wisconsin. Never been there, but just on paper, it has really good population growth. It estimated grew 1.5% just this year. Its unemployment rate is at about 2%, which is much lower than the national average. And it's a highly, highly educated workforce. And to James's point, I'm just going based on affordability. People can afford to live there, and it has a high scores for quality of life, and it is still growing. It is still consistently growing 8 to 10% year over year. And it's been doing that for the last several years, and it's shown no signs of slowing down over the last couple of months. So I think this market is still going to keep growing over the next year. And I don't think it's a fluke. I think it's an affordable market, high quality of life and affordable, which, as James said, sort of some of the key indicators for long-term performance for buy and hold markets. So I tried to do something a little bit weird and a little bit different, but I think Madison's going to be a winner.
Brutal winners.
Yes, definitely brutal winters.
I know. When you said quality of life, I was like, it depends on how much you love cold.
It gets rated high for quality of life. People like it there. But I guess those are all, like James said, like it's like a math equation. They're like, what was your score on like air quality? And what was, like it's those things you probably need to look into a little bit of the methodology.
When you live in perpetual summer like me here in Phoenix, I don't mind seasons.
I've had too many seasons. I don't want them anymore.
I went to school in upstate New York, and it is absolutely brutal. I did not like it. It's not for me.
Why do you think Rich moved from East Coast to West Coast?
Yeah, exactly. But I just think generally, like, I think the Midwest has gotten hit hard, and there's other cities in the Midwest also, I think, are like Chicago, I believe will rebound over the next couple of years. Maybe not. I mean, I think it's doing fine right now, but will start growing again just because it's so much more affordable than other big cities, and there's still really good jobs in these markets.
Cool city too. I love Chicago.
I last time I was there, Jane's family lives there, and I was there over the summer, and man, that city is basically holding down inflation for the entire country. Like, we were going out and like we went and bought beers, and they're like $3 for a beer. And like we go get a sandwich, it'd be like $5.50. And I was like, this place is holding it down. There's stable prices in Chicago since 1990. They're just doing us all a favor.
Chicago's a lot of fun.
I ate lunch yesterday when I was prepping for like doing some work and eating. I got a sandwich and a soda, and it was $33. I was like,
it's ridiculous.
What is going on? Like, I mean, now Chicago might jump up my list if it's really that cheap.
It honestly, it is. It's so cheap there. I mean, relatively speaking. Was your sandwich good at least?
It was good. It was a prime rib dip. It was pretty good.
Oh, he failed to mention it was a prime rib sandwich. It makes sense.
Yeah, it's wagyu beef.
Yeah, when you have wagyu in between bread, James, it's going to be $33.
But that was a $20 meal before the pandemic. That was like a 1994 with a $3 tip on there.
All right. Well, thank you guys. This has been a lot of fun. So let's just sum this up. For the Kathy's picks were worst performing market for next year will be Detroit, but best will be Tampa. James had San Diego as the worst performing market, and his best was
Raleigh.
There we go. Jamil picking Hartford for his best one, bringing a new state onto the map, and he had Ventura County, California, as his worst performing. For me, I think Reno is going to take a hit, but Madison, Wisconsin is my dark horse for next year. All right. Well, thank you all, everyone. We would love to hear on the forums. We just put on the Bigger Pockets forums a question to ask you what all you think the best and worst performing markets of 2023 are going to be. So if you want to interact with us or talk to other listeners about market potential for next year, make sure to visit the Bigger Pockets forums. Just go to biggerpockets.com/forums and you'll find it there. Jamil, James, Kathy, thank you so much for being here. We appreciate you. We appreciate you all for listening, and we'll see you next time for On the Market. On the Market is created by me, Dave Meyer, and Kaylin Bennett. Produced by Kaylin Bennett. Editing by Joel Esparza and Onyx Media. Research by Pooja Jindal. And a big thanks to the entire Bigger Pockets team. The content on the show On the Market are opinions only. All listeners should independently verify data points, opinions, and investment strategies.